This video is a guide on student loan payments. So first we're going to talk about what is discretionary income, right? Because that's what determines payments for income-driven plans. If you do not have an income-driven plan, then your payment's going to be determined based on how much you borrowed. People who do not have issues paying off their student loans based on a 10-year program should go about doing so. However, those that do have an issue with paying off based on a 10-year plan have the option to enroll in a program based on their income. And enrolling in a plan based on your income, your servicer will consider what's called your discretionary income. We're going to talk about what that means, and then also how do you manage your discretionary income to optimally and to best lower your payments based on if you're a W-2 employee or a self-employed person. We're going to go over all of that in this video. Please like, subscribe, give me a thumbs up, comment below if you have any questions, and of course, please share this video to others for who may find this information relevant, okay? So what is discretionary income? Discretionary income is income that the government has deemed that you are not going to use for basic living expenses. So they allot a specific amount of money for you to pay your basic needs, and what they determine as a basic need is based on the federal poverty line, okay? And how each plan recognizes this amount of discretionary income is different based on what they will subtract from your adjusted gross income, okay? So the income that gets reported on like line 11 on your taxes. But basically, the government will say, okay, the SAVE program, for example, will take 225% of the poverty line in your specific state. They'll take 225% of it and say, okay, your income minus 225% based on your family size is what you can afford annually to pay on your student loans. So the annual payment divided by 12 is what your monthly payment is, okay? So that's SAVE. So it will take AGI, adjusted gross income, minus a percentage of the poverty line. And the reason I'm putting a percentage is because Biden's SAVE program will take 225%. Other programs will take 150%. So the government has deemed your basic needs at 150 to 225% of the poverty line. I would say that Biden has increased from 150 to 225% because inflation and the cost of living increases, okay? That will get you your annualized payment. You're going to divide by 12 to get your monthly payment. That is how your student loan payment based on your income is determined, okay? This payment will be the same regardless of whether you borrowed $50,000, $100,000, $200,000, $500,000. It does not depend on how much you have borrowed for your education, which some critics say that they disagree with that because obviously if you borrow more, normally you should pay more, right? But this income-driven repayment plans are not based on how much you borrow. It's completely based on how much you earn. So that's why we should talk about how do you lower your payments if you're a W-2 employee? How do you lower your payments if you're self-employed? Because this formula can be manipulated as long as you can manipulate any of the variables in the formula, right? So let me take a drink of water there. For example, in this formula, what can you manipulate? Obviously, you can't manipulate the poverty line that's set by the government, but you can manipulate your adjusted gross income. And how I say you can manipulate that, it's not illegal. It's just using different proof of income to help your servicer come up with your adjusted gross income. So for example, if you earn more money this year and you earned less last year, you're not going to use the proof of income based on the year where you earn the most. Let's say this year I earned 70 and last year I earned 62. Well, you're going to use the year in which you earned less to reduce that adjusted gross amount so that your payment can be less. Is that clear? Especially if you're a W-2 employee, that is the way to go. So let's say last year you earned less, 2022, you could submit your 2022 earnings. You wouldn't submit your pay stub, right? That's an example. Let's say you're between jobs, as an example, and you earn $0. Okay, you can go and ask your servicer to recalculate your income at $0 and get a $0 payment for the year. You do not need to refile after you get a job, right? That is a way to manipulate the adjusted gross income if you are a W-2 employee. If you need help understanding how to personally do it for your scenario, of course, we at LoanSense are here to help you understand that. Again, myloansense.com. The links are below. Now let's talk if you're self-employed. The reason being self-employed is really valuable in this adjusted gross income formula is because as a self-employed person, you can write off all types of expenses like home office, right? You could write off square footage in your home as using for a home office. There's all kinds of different write-offs you can do as a self-employed person that will help you reduce this adjusted gross income. That is how you as a self-employed person can manipulate the amount used in the adjusted gross income. Let's say you as a self-employed person are between contracts and have no employment income at the time. That is also a way you can reduce your adjusted gross income down to $0 and also qualify, right? The interesting thing about being a self-employed person is you can self-certify your income with your servicers. So as a self-employed person, obviously you're not going to lie. You're not going to say you earn you're not going to say you earn 10,000 when you earn 100,000 because that's, you can get in trouble. And you also state that you're being truthful in the application, right? But there are ways to be legal about how to reduce your adjusted gross income, like applying when you are between jobs or between gigs, whether you're W-2 or self-employed, that will allow you to reduce the AGI for 1 year down to $0. Another way to manipulate the discretionary income formula is obviously if you're married, if you have dependents. Also, another way to manipulate it is based on your marriage tax filing status. If you file separately, then you don't need to use your spouse's income in the formula, right? So that reduces your adjusted gross income. Whereas if you're married filing jointly, you will have to include your spouse's income. So there's another way to consider manipulating the adjusted gross income in the discretionary income formula. So as a self-employed person, what is great is you can say, like, you can self-certify your income. You could file separate to not include your spouse's income. And if you have dependents, obviously the poverty line goes up, right? So if you have dependents, then the poverty line goes up. So there's different ways besides just the AGI that you can manipulate the payment. But we see payments reduce even for married couples pretty significantly if they file separate, because both people, especially if they have children, get to claim the dependents for the purpose of student loans. As a result, the poverty line is higher because both people get to account for the dependents. So that reduces the payment for both parties. And by the way, whether you should consider, if you're married, filing your income taxes jointly or separately is completely dependent on your scenario, including both people's income and both people's student loans. I hope this was really helpful. And again, if we can be of assistance to help you understand how to lower your student loan payments as we get kicked in to high gear with repayments starting, we are here on standby, myloansense.com. Please like, share, subscribe, and we can't wait to help you.